Welcome to the Center for Investment Excellence, a production of J.P. Morgan Asset Management. The Center for Investment Excellence is an audio podcast that provides educational insights across asset classes and investment themes. Today's episode is entitled Understanding Public and Private Equity. I'm David Lebovitz, Global Strategist in Multi-Asset Solutions and host of the Center for Investment Excellence. With me today is Jared Gross, the Head of Institutional Portfolio Strategy for J.P. Morgan Asset Management. Hi, everyone, and welcome to the Center for Investment Excellence. I'm joined here today by Jared Gross, the Head of Institutional Portfolio Strategy here at J.P. Morgan Asset Management, to discuss the third in a series of three papers that have come out of the Strategic Investment Advisory Group, or SIAG, over the course of 2024. Just as a reminder, the first piece was on real estate. The second piece was on credit. Now we've moved on to public versus private equity. So, Jared, glad to have you back and looking forward to the conversation.
Yeah, thanks, David. I'm looking forward to exploring this topic and the upcoming publication of the paper. As you noted, throughout this series, we have tried to offer some insights into how various asset classes, kind of relate across public and private markets, how they compare to one another, where they overlap, and where they offer distinct opportunities. So in the case of public and private equity, we sort of start from this basic principle that they share this key common factor, which is that they draw their returns from the earnings and cash flow of commercial businesses or commercial enterprise. But as investments, they're very different. Public equity is dominated by broad market risk, beta, and is characterized by high volatility, whereas private equity is characterized by idiosyncratic performance across funds, across vintage years, by manager, as well as extreme illiquidity. So it's a very rich topic, and it was a great discussion that we go through in the paper. But let's just sort of get down to today's call and get into it.
Absolutely. So I think that the first thing, or the best place to start, is really thinking about the performance differential between public and private markets, because both public and private equity have delivered very strong returns over time, but with very different volatilities. And I think that that's really the key point. You have in private equity these assets that are not marked to market quite as frequently. As a result, it's more about accounting volatility as opposed to economic volatility. And that's part of the reason why private equity works so well in traditional asset allocation models that are driven by return, volatility, and correlation. Because if you have an asset that has historically generated a higher rate of return with a lower overall volatility, the model's going to tell you to pile in there. But I think it's important to look at private equity returns with at least a little bit of scrutiny, because the first thing is that a lot of this performance is measured using IRR. And as we all know, you can't eat IRR. The second thing has to do with the dispersion of returns. And what we see is that the dispersion of returns in private equity markets, global private equity markets, is 10 times what we've seen in public equity markets over the course of the past 10 years. And so there's this element of cyclicality which shows up in both public as well as in private equity numbers. But I think that the real differentiator between the two is really, one, that point about volatility and the realized volatility of private equity being lower, at least until it's not. And second of all, that dispersion of returns, where I've never met an investor who wasn't looking for a top quartile private equity manager. But the reality is that those can be kind of difficult to find.
100%. I agree. And, in the paper, we really dig into this issue of the comparison between the two. And I think there's two interesting points that come out of that discussion. One is, it's become commonplace to compare active private equity returns, because almost by definition, any private equity investment is an active investment. There is no such thing as passive private equity. But we compare those active private equity returns to passive public equity returns. And that leads to this pretty stark return differential between the two asset classes across time. And as you correctly note, there's a lot of variation across the range of managers. There's a lot of dispersion and so forth. But, in aggregate, private equity has outperformed. The question is by how much? And we do think that when you really dig into where those returns are coming from, the gap is probably a little bit overstated, not because we're overstating private equity returns, but because we're probably understating what the public markets can actually deliver if you construct a more thoughtful portfolio strategy. And then the second point that we make is that the illiquidity of private equity does bring with it certain costs, but those costs are borne elsewhere in the portfolio. They don't really come back to the private equity managers or returns or the asset class in any way that's really accountable. And so the failure to properly account for those costs, I think, leads to this perception of private equity having this very large advantage over public equity. And if you do account for those costs, of course, it goes the other way, and that advantage narrows. So I think, those are some really important points to get on the table early, and we'll talk about this in more detail, but it really is about that comparison between the two and how investors should think through those trade-offs.
So before we move on and talk about some of those costs and some of those trade-offs, I think it would behoove us to start with the elephant in the room, which is obviously returns. And so how do you think, and how does the team think we should be kind of thinking through that idea of comparing public and private markets? One is a time-weighted return, one is an IRR. There are other differences as well, but would love to get your thoughts on the return piece of the conversation.
Yeah, so I'll start with the IRR point briefly, which is that internal rate of return has become the norm for describing private equity returns, and I think it works well if you're comparing private investments to other private investments. It works less well if you're comparing private investments to public investments, and there are some ways around that. People use time-weighted return or other metrics that put them on more of a level playing field. So we'll start from that point. The next thing I would say is, it has become commonplace for investors to assert that private equity carries this premium. It's often called an illiquidity premium, but it's not clear that it's
actually the
precisely from anything about the illiquidity itself. And that premium is typically quoted in the range of 300 to 500 basis points of excess return over time. And so what we wanted to do in some of our analysis was explore where those returns originate and really see if we could separate the portion of the return premium that's derived from factors that can be replicated in public markets and separate that from the portion of the return premium that appears to be derived from factors that are intrinsic to private investing. Yep. And what we found is interesting. We really kind of broke it into two questions. First question was, what sectors do private equity funds prefer to operate in? And very briefly, there's an overweight to technology relative to the Russell 2. There's an overweight to communications. There's also an overweight to industrials. And there's a pretty pronounced underweight to things like financials, energy, and real estate. Now, those change across time, so we don't want to make too much of it, but we'll simply note that an investor in the public markets can tilt their portfolio to those same sectors. So if there's something about that part of the economy or that business grouping that adds value, either side can take advantage of that. And then the second question we asked was, is there a particular set of financial characteristics that we can derive from the population of take-private transactions, so public-to-private buyouts? And we looked at over 1,000 such transactions, and what we found, I think unsurprisingly, was a preference for profitable companies with a lot of cash flow and relatively limited CapEx requirements. And, to put it differently, these are companies that can support an LBO.
Right.
They have the balance sheets and the revenue and the cash flow to support leverage. And so if we looked at the top quintile of companies that have those characteristics and the sector weights, and we build essentially a synthetic portfolio, a new benchmark to reflect that, essentially looking not at the Russell 2000, but at this subset of the public markets that more closely resembles what private equity is doing, we found that there's a significant premium. It generates more than 200 basis points of excess return. It does come with higher volatility, about 175 basis points of higher vol, but the Sharpe ratio improves. So it's in the favor of the investor. And so we don't do this to kind of imply that we've cracked the code of private equity investing. It's really just, I think, a proof point that that sort of simplistic comparison of median private equity returns, which are by their nature active with a passive benchmark, is missing something. And it's missing it in the direction that favors private equity. Just to be clear, though, that gap in returns does not disappear. There are elements of private equity returns that the public markets cannot deliver, and that's largely the result of control.
Right.
You can control the balance sheet, you can control the operations, you can do dividend recaps to bring cash out of the company back to investors. So there's a variety of ways in which private equity investment can generate returns that a public investor cannot create for themselves. But to sort of bring it back to the allocation side of things, for that reason, we do think that investors who are active in both public and private equity should be thoughtful about tilting their strategies to minimize the overlap and think about parts of the private markets where you're doing things that cannot be as easily replicated in the public markets at lower fees, lower cost, greater liquidity, et cetera. So we think that's a really interesting takeaway, and I know you can kind of dive into some of those sector weights and what they represent.
Absolutely, but I think that the key point there is think about what public equity can do, think about what private equity can do, think about where the overlap is, and then lean in accordingly. Because as you dig through the private equity space, to the point that you made, there's a ton of differentiation between strategies in terms of the overall approach, in terms of the capitalization. Two examples would just be venture capital versus small and middle market buyout. Right, so venture capital, growth equity, these are funds that are providing capital to emerging businesses. They're a little bit more mature than perhaps a seed or the initial stages of where VC tends to fish. But you have a business model here that is simply in need of more capital. And then as you move along kind of the life cycle of a company, right, you eventually become a small to medium-sized enterprise. You're probably generating a profit. You can kind of operate on your own, as you alluded to just a couple of minutes ago. You have that established viability, but again, you need capital in order to grow further. And so these to us are two really interesting areas of the private equity universe. And when we think about venture capital and growth equity in particular, obviously, there was a seismic boom there during the pandemic with zero rates, tons of liquidity, and deals just being done at a breakneck pace. We've since seen normalization there, right? Things are back in line with their pre-pandemic trend, and we don't necessarily think that's a bad thing. We think that normalization is a good thing and continue to see significant opportunity in things like technology, biotech, life sciences, so on and so forth. Interestingly, the growth of not just venture capital, but I would argue the growth of private markets more broadly has allowed for this dynamic where companies can now stay private longer and command higher valuations when they do in fact go public, right? You don't need to go to the public equity markets in order to generate growth capital. It's more about a recapitalization of the owner or the founder, and that's actually something that we wrote about in our long-term capital market assumptions a couple of years back. On the other hand, when you look at small and mid-sized buyout, the main driver here, right, is the formation of new companies and the evolution of those companies. And as we've seen in the United States in particular, small business formation, new business formation has been running at all-time highs or near to all-time highs since the pandemic. There are a lot of different theories as to why that has become the case, but I think a decent chunk of it had to do with the fact that people got laid off from their jobs when COVID showed up. They were at home. They figured out they could do it from home. They started their own business. And that has very much continued over the course of the past couple of years. When you look at the statistics, there are now almost 150,000 private companies in the United States with revenue between $10 and $300 million. And the reason why that is so important is because the large buyout managers really can't play in that universe, right? The companies are too small. And so the dynamic that you see subsequently play out is you have these small and medium-sized focused buyout managers operating in this market. They go in, they buy the company, maybe they do a little bit to it, but at the end of the day, they really just sell it to the big guys for a higher price. And that's what generates a lot of return from that space. And again, we've seen that play out very much over the past couple of years when we've seen private equity overall obviously be a bit challenged. And so, the success of this model, in addition to the risk, I think is really most evident in the distribution of fund returns. Because going back to that dispersion issue, when you look at the top quartile, when you look at the bottom quartile, that's where the smaller fund managers are showing up. That's where the managers who are focused on these small and medium-sized businesses tend to hang their hats. You look at the center of the distribution, and it's the mega cap buyout managers, right? And so by playing in this pond, you can do really well, but you can also strike out to an extent, given that dispersion in manager returns. And, when we think about what's going on here and why this is the case, right, smaller firms are more capital constrained, more likely to respond favorably, to that addition of growth capital. You think about the types of deals that have been getting done as of late. It's been about add-ons and platform creation, so on and so forth. That creates synergies, which again allow these businesses to grow. And finally, if you're a small and medium-sized business, you might actually benefit from having somebody come on board who knows what they're doing and has experience there. And so manager selection matters much more. Returns in the top quartile are much higher than the average manager. And importantly, that top and bottom quartile very much tilted to the smaller managers. And so if you can do the due diligence on these names, that's arguably where the opportunity really does lie.
Yeah, I think that you hit the nail on the head with that last comment. The diligence is critical because it's a very granular marketplace. I think many investors find it easy to just go to the large names who have been around for a long time. And as you said, they generally will produce sort of middle of the distribution returns. Those are not bad returns. They may be better than public equity returns.
Right.
But if you're trying to hit that top quartile, odds are you need to be looking among smaller managers. And that, I think puts a thumb on the scale in favor of bringing in some outside help to go sift through those managers, whether that's a consultant or a fund of funds, something that gets you over the hump in terms of due diligence. And I think that leads to the next phase of the paper really neatly, which is this operational complexity and how the shifting market conditions have made risks in that complex sort of mechanism come to the fore. And then what do we mean by that? Well, PE, private equity, is almost unique among asset classes in the demands that it places on investors to constantly operate with skill at multiple layers of the investment process. And so what do we mean by that? We think about kind of four broad phases. The first would be the capital commitment and the calling of capital. So, how do the funds themselves go out to investors to raise the money and then call that money when they're ready to make the investments and do the deals? Then you've got the investment itself, the deal making and the financing of those deals is another phase, critically important to how value will be created. And then once the deals have been done and those companies are now owned by the private equity fund, you've got this value creation period. Again, that can be through financial engineering, it can be operational improvement, it can be through scale and add-ons. There's a variety of ways to do that. And you ultimately get to the point of exit where you've added enough value, hopefully over a reasonable time horizon, to generate a high internal rate of return. And that exit can be through an IPO, it can be through a strategic sale to a public company. In either of those cases, the company goes back into the public markets, either on its own or as part of a larger firm. Or it could be something you mentioned earlier, a sponsor-to-sponsor deal, where a larger sponsor simply buys out the sort of work product of a smaller sponsor. And then the final phase is the distribution of that capital and the reinvestment, which again falls more on the investor to manage vintage years and manage the manager selection process so that the money is always being recycled. Because one of the things that we observe is that if you're not recycling the capital efficiently, it's very hard to achieve the types of returns that people really want. Now, today's market environment, and we spend a lot of time in the paper going through this in detail, but I'll be fairly brief here, has a number of challenges to kind of the smooth operation of that mechanism. So what are we seeing? Well, one, the pace of capital raising has barely slowed, but it is becoming more concentrated in larger funds. So 2023 fundraising was more or less on par with 2022, but half the number of funds were in the market.
Right.
So skewing to larger funds. And based on what you were saying earlier, it's not clear that that's value add from the investor's perspective. It may just reflect safety or the perception of safety. Second point is that capital calls have slowed down and deal activity has slowed down. So there's a buildup of dry powder. So right now, most estimates would say there's over $1 trillion of dry powder, and it's becoming a little bit stale. More than a quarter of that dry powder is 4 years or older in the commitment phase, or since the commitment was made. And that should be a little concerning because eventually that money has to get called and put to work before the next round of funds can start investing. The investment activity and the deal activity has slowed, and we attribute some of that to financing costs, which have made the economics of transactions more challenging and kind of raised the bar for the type of transactions that can get done. Leverage is coming down, which we think is prudent given the higher cost of leverage, but it will ultimately diminish returns. And we would note that, as the sponsors have pivoted from syndicated loans to private credit as the main source of their financing, the cost of that financing has risen. So private credit has some advantages in terms of execution and flexibility, but it does tend to come at a higher cost. We think, in this higher rate environment, the value creation from financial engineering is a little harder to achieve because that tends to require leverage and borrowing to create that value. Value creation from operational enhancements we think is completely viable, but that's a longer term process. If you're going to really get your hands dirty in the operations of a business, improve its systems, improve its marketing, improve its ability to address customers. Those are great ways to add value, but they don't happen overnight. And so that's going to tend to extend the time horizon over which these investments mature and ultimately probably put a little pressure on returns as a result. And so we're starting to see distributions coming down, funds timelines are extending, and we're also seeing something a little concerning, which is that rather than exiting and using that exit as the source of capital to return to investors, many GPs are doing NAV financing, where they're essentially borrowing against the fund to return capital, essentially rolling forward that realization of value. And there's a lot of reasons to think that NAV financing is not the most sort of capital efficient way for investors to achieve their returns.
Right.
So all of this sort of boils down to that investors are facing, I think, a more difficult decision-making environment about where to allocate capital, where to reinvest capital that's distributed, and how to keep this machine running. Because if it doesn't run efficiently, the returns will not be on par with what we've become accustomed to.
Exactly. And I think that's the key point, is that this ecosystem has evolved where it kind of feeds on itself. And to your point, if the machine stops running for any reason, that creates broader problems. But, kind of bringing this all to a head and putting a bow on it, we started by talking about allocation and illiquidity, and whether these better returns from private equity are due to illiquidity, are they due to other things, are there certain things you can do like operational improvements that are a function of less liquidity, right? I think it's a very muddled kind of picture at the end of the day, but there is clearly a cost of this illiquidity, and I think this is something in particular that not a lot of people spend enough time thinking about, because to us, yes, allocating capital to illiquid private strategies, it can enhance returns, it can improve diversification, so on and so forth, but it also can impose costs elsewhere in the broader asset allocation. And we effectively see three ways that those costs are born. The first is vis-a-vis the denominator effect. And we saw that in spades back in 2022 when public markets, basically crashed, whether it was stock or bond, it didn't really matter. Worst 60-40 return since the 1970s, and nothing really happened to the value of private investments. And as a result, you had this imbalance created in the portfolio where the private investments grew as an overall share because the public investments had seen a contraction that the privates simply did not experience. The second thing is, when public portfolios are forced to provide liquidity during a market downturn. And, we always think about try to buy low and sell high. Well, the reality is if you can't liquidate your private investment, or it's very costly to do so through the secondary market, and you need liquidity when public markets are down, well, now you're selling low, which is what we all try to avoid. And that, again, imposes a cost on the overall portfolio. And then finally, the inability to rebalance into public markets when they have sold off is yet another, and the third cost that we see this illiquidity as having an impact on the overall portfolio. If you can't get dry powder when public markets are down 20%, you're not going to be able to ride that wave. And you very astutely made the point that from the lows in 2022 through the end of May of 2024, the S&P 500 was up something like 40%. And so if you hadn't been able to rebalance in when prices had come down, you basically put a drag on your portfolio that could have been avoided. And so a lot of people think about the benefits of illiquidity, which they're obviously there, and we spent a lot of time talking about them here today, but there are also costs to the illiquidity, which I think from an allocator perspective is a particularly important point to keep in mind.
Yeah, I think you hit the nail on the head there. I think there's a few points I'll just finish with. the general perception is that private equity has an advantage, and that advantage is characterized as this illiquidity premium. And investors rarely take the time to consider the costs that illiquidity imposes elsewhere. And the failure to reckon with those costs and frankly, the inability of traditional asset allocation models, and you went through this early on, those models are built around returns, volatilities, and correlation. Liquidity is not one of the variables that they address. And so it tends to make illiquid assets look better. And so investors impose sort of constraints on their illiquid portfolio and they limit the size. But no matter where they limit that size, the model will sort of push capital to the maximum value that's allowed. And, I think when we step back and look at public and private relative to one another, taking into account some of these liquidity challenges, the value starts to become a little more comparable.
Mm-hmm.
And we think these are both incredibly valuable asset classes. There's no other source of return beyond equity that has delivered for investors over the many, many decades, if not centuries, that the markets have been in operation. And so you have to be in equity.
Mm-hmm.
And, I think being in public and private makes sense because they represent access points to the economy and to commercial activity and to these enterprises that don't necessarily overlap. And so an investor who wants to gain sort of the full exposure, to have a full expression of the markets in their portfolio, should absolutely have both. But where that overlap becomes visible is where caution should be taken and a more deep analysis of the relative merits of public and private equity is warranted. And I think that's really where we want, the readers of this paper to sort of come away is this recognition that, these are incredibly useful, but the historical model has to sort of catch up to reality today.
No, I think that's spot on. And, just like we always remind clients and investors that it's not about active or passive, it's about active and passive in public markets. When we think about equities more broadly, it's not about public or private, it's about public and private. And that's the way that I think allocators and investors really need to be thinking about, the equity space broadly going forward. So, Jared, as always, a pleasure to have you on the podcast. Thanks again for joining me. And I'm sure we'll see you back here again sometime soon.
Yeah, thanks, David. This is great.
Thank you for joining us today on JP Morgan's Center for Investment Excellence. If you found our insights useful, you can find more episodes anywhere you listen to podcasts, on our website, and on our JP Morgan Asset Management YouTube channel.
This content is intended for information only based on assumptions and current market conditions and are subject to change. No warranty of accuracy is given. This content does not contain sufficient information to support investment decisions. It is not to be construed as research, legal, regulatory, tax, accounting, or investment advice. Investments involve risks. Investors should seek professional advice or make an independent evaluation before investing. The value of investments and the income from them may fluctuate, including loss of capital. Past performance and yield are not indicative of current or future results. Forecasts and estimates may or may not come to pass. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.